It's that time again as we join Bruno Estier in the studio for the technical market analysis. Bruno, good morning.
Good morning, Sam.
So I suppose the strong employment data was the big news from last week, but how is that impacting your charts?
You're right. If we take the 10-year US yield here, we see that last Friday was a big up days from with a move of 222 towards 235. And what we can say is that probably we are making a new high above the previous high of September. That's good because that creates an uptrend, if you wish, with higher lows also here. So we are getting away from the deflation risk.
Okay. What about the direct impact in other areas as well?
Well, you see, a direct impact of rising rates has a strong negative influence on the sector of utilities in the US. And we see that it was a bit anticipated, and on the day of the news it came down quite heavily. On the other hand, if rates are rising, that means that the spreads that banks can lend and borrow still at cheap rates is increasing, and therefore that favors banks. And we see that the relative strength of banks versus the S&P had a big rise, as well as the financial sector.
Okay, so on the flip side then, what about the indirect impact?
Well, the indirect impact is the fact that people expect the Fed to raise rates, and therefore the US dollar index has been moving quite a lot. It just broke the previous high of August, make a really strong up day, and is testing the previous highs of April. So we can say that really now we have a relatively nice since October uptrend, and that probably means that the consolidation which lasted for 6 months is over and the uptrend is resuming. And that has also an influence on the CRB. The CRB is marginally more down. Commodities are coming down.
Yeah, so I guess then the energy sector is not doing so well.
Exactly. You see the energy sector is impacted with a relative strength which is diminishing, and also a relatively nice pause, a corrective pause recently. However, we should remember that this sector has been impacted quite a lot already and has declined a lot. So probably it is just a pause in a rebound and not really a big new downtrend. Also, we noticed that the other sector which was impacted by declining commodities was materials, and we also see a relatively modest pullback. But clearly, the relative strength here on the top part is not improving, so that means it is impacted negatively.
Okay, let's have a look at the European stocks then. How is the stronger dollar hitting those?
A stronger dollar means a weaker euro, and a weaker euro means a help for the export of Europe. That has helped a little bit the relative strength, in the sense that it's not declining. Usually when you have a correction, euro stocks decline more. That's not the case here. So we can suspect that when we look at euro stocks, that the pullback is probably going to hold above the cloud. That means 3,350. So it can last a little bit more, maybe a few more weeks until the end of November, but that support should be important.
Okay, and for Japan?
Japan, a higher dollar means a lower yen, same thing basically. And what we see here, that the impact on the Nikkei is much stronger. The relative strength of the Nikkei versus the S&P is rising much faster. Also, we probably will have to reconsider our view that while we broke 20,000, we were quite cautious. If we are able to move back above 20,000, then probably we will see also investors coming back to Japan in a more active way.
Okay, so what about US equities? Is the uptrend still intact?
Well, we had a small correction which started in the last 4 or 5 days. We can say that the rebound has been broken because the support trend line has been broken 5 days ago. However, the pullback is relatively modest. It's only 23% of this rise. So what's going to happen most probably is we just witnessed the first down leg, and a correction is usually made of 2 down legs. So there is an intermediary rebound, which is going to be modest in the coming days, and probably into the end of November, a second down leg, which could go towards 2020. That's probably what the worst thing we can expect. And we see that this 2020 level corresponds also to somehow the daily cloud. So there should be some support there at the 38% Fibonacci retracement. And when we look at the weekly, really what we see is that the weekly cloud is still below the prices. So moving into 2020 is just entering the cloud but not breaking it. So we put an arrow which is more sideways, saying that basically we're going to make a consolidation. What happened then we will see later.
Okay then. So finally for today, what about the impact of the strong dollar on emerging markets?
Well, a rising dollar means lower commodities, as we saw before, and that's not too good for emerging market. And exactly as along the route, the relative strength of emerging market versus the S&P is coming down also in the last 5 days. Commodities is coming down. Here we have copper, and we see that the pullback is relatively more intense in the emerging market than in other markets. We consider that emerging markets are still a bit too risky, and they are probably not an area to overweight. And we see that this is also the case for China. We saw in the last few days also the relative strength of China versus the S&P coming down. And that's also, we see that it's testing the lower Bollinger Bands of a very narrow range, so it's a little bit hedgy. So all in all, basically we have to realize that there is a correction. Probably it's not going to be a huge one, but volatility could increase a little bit in the coming days.
Okay, Bruno, thank you very much.
You're welcome.
And thank you for watching. Be sure to click back to Dukascopy TV for more updates and exclusive interviews. We'll see you next time.